Welcome to Safe, Simple Sound Tax Edition. I'm Alex, your host, and I'm joined by Sam, our tax expert, and Taylor, who asks the questions you might have on your mind. Together, we break down complex tax topics into clear, actionable insights. We use AI-enhanced voices to deliver consistent, high-quality content while keeping our focus on what matters most, helping you understand your taxes. In each episode, I'll guide our discussion, Sam will provide expert analysis, and Taylor will make sure we explain everything in plain English. We're here to make taxes approachable, whether you're filing a basic return or dealing with more complex situations. But before we dive in, a quick note. This podcast is for entertainment only and does not constitute tax, financial, legal, or professional advice. Tax decisions should always consider your personal circumstances, filing status, and specific situation. All tax amounts, thresholds, and deduction values mentioned are examples only. Tax numbers change annually, and you must use the current official values from irs.gov when preparing your returns. Be sure to consult a qualified tax professional before making any tax-related decisions. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Let's get started. Today, we're diving deep into the often dreaded but incredibly important world of IRS penalties. Today's episode is based on an IRS Publication 17 outlining the various penalties you might face for not filing or paying your taxes correctly. Now, at Safe Simple Sound, we believe in seizing financial control and understanding financial choices, and understanding tax penalties is a critical part of both. This Publication 17 provides a stark reminder of the consequences of neglecting our tax obligations, emphasizing the importance of timely filing, accurate reporting, and proactive communication with the IRS. One key takeaway is the significant financial burden that can result from seemingly small oversights, like late filing. Another crucial point is the distinction between unintentional errors and intentional fraud, each carrying different penalties, and the importance of creating a financial safety net to handle unexpected tax liabilities. Our episode today will follow a three-part structure. First, we'll tackle failure to file and pay penalties, exploring the common pitfalls of procrastination with the procrastinator and the challenges of unexpected financial hardship with the unexpected hardship. Then, we'll move on to accuracy-related penalties, examining the dangers of DIY deductions gone wrong in the DIY deduction disaster and the consequences of overlooking foreign accounts in the overlooked foreign account. Finally, we'll confront the serious consequences of fraud and frivolous filings, using scenarios like the inflated expense report and the tax protester to understand the significant legal and ethical implications. So, get ready to unpack these crucial topics, learn from real-life scenarios, and empower yourselves to navigate the tax landscape effectively. Let's dive in. Our first scenario today is the procrastinator. We'll be looking at the case of a self-employed individual who consistently files their taxes late, racking up penalties year after year due to procrastination and poor organization. They're essentially kicking the can down the road, not realizing how heavily this seemingly small issue can impact their long-term financial well-being.
This sounds like a trap it's easy to fall into. I mean, life gets busy, things slip through the cracks. How can procrastination with taxes actually become a significant financial burden?
Exactly the right question, Taylor. That's where Sam's expertise comes in. Sam, can you break down the penalty structure for us and explain how these penalties can accumulate?
Sure, the IRS imposes penalties for both failing to file on time and failing to pay on time. The failure to file penalty is typically 5% of the unpaid taxes for each month or part of a month your return is late, up to a maximum of 25%. So even being a few days late into a new month incurs another 5%. Then there's the failure to pay penalty, which is 0.5% of the unpaid taxes for each month or part of a month, also capped at 25%. If both penalties apply, the 5% failure to file is reduced by the 0.5% failure to pay, but they can still add up quickly.
So, if I understand correctly, if someone owes $2,000 and is 3 months late filing, the failure to file penalty could be 5% times $2,000 times 3 months. And if they also haven't paid, they'd accrue an additional failure to pay penalty, though at a lower rate. That's a pretty hefty chunk of change just for being late.
Precisely. And imagine this happening year after year. The penalties compound the existing tax debt, making it increasingly difficult to catch up. It becomes a vicious cycle.
That brings us to our second key question. What simple organizational strategies can prevent this late filing nightmare and the associated penalties?
This reminds me of overall importance of budgeting and tracking expenses. Wouldn't good financial record keeping also help with tax preparation?
Absolutely. Maintaining organized records throughout the year simplifies the tax filing process significantly. Dedicated folders, digital spreadsheets, or accounting software, whatever method works best, can make a huge difference.
So, setting up calendar reminders for key tax deadlines, organizing your financial records throughout the year, and possibly even consulting with a tax professional, especially if self-employed, can save you significant money in the long run.
It makes a lot of sense to be proactive and organized. The cost of ignoring these things seems way higher than the effort required to stay on top of it.
Precisely. Small steps can prevent big headaches down the line. To recap, procrastination with taxes can lead to substantial penalties that accumulate over time. Simple strategies like organized record keeping and setting reminders can help you avoid these pitfalls. So, Taylor, we just discussed how procrastination can lead to penalties, even if you ultimately can pay what you owe. But what happens when life throws you a curveball and you genuinely can't pay your taxes on time, even if you want to? That's what we're exploring in our next scenario. Our second scenario is called the unexpected hardship. Imagine a small business owner. Let's call her Maria. Maria's business was thriving, but then a sudden economic downturn hits, impacting her revenue significantly. She finds herself unable to pay her taxes on time. Unfortunately, overwhelmed and fearful, Maria avoids contacting the IRS, hoping the problem will magically disappear. Spoiler alert, it doesn't. Sam, what resources are available for taxpayers like Maria facing financial hardship?
The IRS actually offers several options for those struggling to pay. First, there are short-term payment plans for up to 180 days, which can give taxpayers some breathing room to gather the necessary funds. Then there are offer in compromise (OIC) programs, where the IRS might accept less than the full amount owed if the taxpayer demonstrates genuine inability to pay the full amount. Finally, there are also installment agreements, allowing taxpayers to pay off their tax debt in manageable monthly payments.
So, if I understand correctly, even if you can't pay the full amount immediately, there are ways to work with the IRS to avoid some of the penalties that come with just ignoring the problem. This is a relief to hear. This reminds me of what we discussed earlier about how penalties accumulate quickly. Avoiding them in the first place seems like the best strategy.
Exactly, Taylor. And that's why proactive communication is so crucial. Sam, how can communicating with the IRS early on mitigate penalties in these difficult circumstances?
As Publication 17 explains, penalties for failure to pay are typically 0.5% of the unpaid taxes per month, up to a maximum of 25%. However, this rate is halved to 0.25% if an installment agreement is in place. By contacting the IRS early and setting up a payment plan, Maria could significantly reduce the penalties she accrues. Additionally, the IRS may be more willing to work with taxpayers who demonstrate a willingness to cooperate and address their tax obligations.
That makes perfect sense. It's like showing good faith. Even if you're struggling, showing you're trying to find a solution probably goes a long way. What if Maria is so overwhelmed that she doesn't even know where to start with contacting the IRS or understanding these options?
The IRS website is a good starting point. It has detailed information about payment options and instructions on how to apply. There are also taxpayer assistance centers across the country where individuals can get in-person help. Additionally, low-income taxpayers might qualify for free tax preparation assistance through programs like Volunteer Income Tax Assistance (VITA).
Great point, Sam. It's important to remember you're not alone in this. There are resources and people who can help you navigate these complex situations. So, to recap, if you anticipate difficulty paying your taxes, reaching out to the IRS proactively can significantly lessen the financial burden. There are payment plans, offers in compromise, and installment agreements available. And there are resources to help you understand these options and get the support you need. Remember our key takeaway. If you anticipate difficulty paying your taxes, contact the IRS immediately to explore payment options and avoid further penalties. Don't let fear or uncertainty make the problem worse. While we're on the subject of avoiding penalties, let's shift gears to discuss another common pitfall: accuracy-related penalties. This happens when errors on your tax return lead to an underpayment. Our next scenario looks at what happens when someone tries to take deductions they're not actually entitled to, with disastrous results. Our next scenario is called the DIY deduction disaster. Imagine someone, let's call him Bob, trying to minimize his tax burden. He's heard about all these deductions and decides to claim as many as possible, stretching the truth a little here, overlooking a requirement there. Bob thinks he's being clever, but ends up facing an accuracy-related penalty due to negligence. So, Sam, let's start with some common misconceptions. What are some of the things people get wrong about tax deductions that can land them in hot water? And Taylor, what are your initial thoughts on this? What kind of mistakes do you think people might make?
Well, I think sometimes people hear about a deduction and assume it applies to them without really digging into the specifics. Like maybe they heard a friend talking about deducting home office expenses and just assume they can do it too, even if they only occasionally work from home. Or maybe they're not keeping good records. I know I struggle with that sometimes.
Taylor, you've hit on two major points: eligibility and documentation. A common misconception is that any expense remotely related to work is deductible. The reality is each deduction has specific criteria. The home office deduction, as you mentioned, has strict rules about exclusive and regular use. Another misconception is that estimations are good enough. The IRS wants to see documentation, receipts, invoices, logs, proving the expense was incurred and qualifies.
That's a great point about documentation, Sam. It's like trying to return a shirt without the receipt. The store needs proof of purchase. The IRS operates similarly. Taylor, does that analogy make sense?
Yes, totally. So if I understand correctly, even if I'm technically eligible for a deduction, I can still be penalized if I don't have the proper documentation.
Exactly. The IRS Publication 17 calls this negligence, failing to keep adequate books and records. And remember, even a seemingly small oversight can trigger a penalty equal to 20% of the underpayment.
Let's talk about ways to avoid these issues. Sam, what advice would you give someone like Bob in our scenario to ensure they're claiming deductions accurately?
First, understand the rules. The IRS publications and website are valuable resources, though they can be dense. Consulting a tax professional can provide personalized guidance. Second, maintain meticulous records. Organize your receipts, track mileage, keep a log of business expenses. Software can automate this process. Third, if you're unsure about a deduction, err on the side of caution. It's better to miss out on a small deduction than to face a significant penalty.
This reminds me of what we discussed about reasonable cause in the last segment. Even with good intentions, ignorance of the rules isn't a defense. So if I'm unsure, I should really seek clarification either through reliable resources or by talking to a professional.
Absolutely, Taylor. That proactive approach can save you a lot of trouble down the line. So, to recap, accuracy-related penalties can stem from negligence, including claiming ineligible deductions or lacking proper documentation. Maintaining accurate records and understanding the specifics of each deduction is crucial. And if you're in doubt, consult a tax professional or utilize reputable resources like the IRS website or publications. Don't be a Bob. Take the time to understand the rules and keep accurate records. Speaking of specific rules and potential pitfalls, let's move on to another scenario where accurate reporting is paramount, a situation involving undisclosed foreign accounts. This can have even more serious consequences, as we'll explore next. We'll call this scenario the overlooked foreign account. Imagine a U.S. citizen living abroad who, perhaps unintentionally, fails to report a foreign bank account. This seemingly simple oversight can lead to some pretty hefty penalties. Now, Taylor, what comes to mind when we talk about reporting requirements for U.S. citizens with foreign financial assets? What do you think they need to be aware of?
Honestly, Alex, it sounds a bit intimidating. I know there's something about reporting foreign accounts, but the specifics are fuzzy. Doesn't it mostly apply to really wealthy individuals hiding money offshore?
That's a common misconception, Taylor. While the rules certainly impact high net worth individuals, they apply to all U.S. citizens and residents with foreign financial assets above certain thresholds. For example, if the aggregate value of your foreign accounts exceeds $10,000 at any time during the year, you're likely required to file a Report of Foreign Bank and Financial Accounts, often called an FBAR.
So, if I have a small savings account in my parents' country that I barely touch and it dips above $10,000 for even a short period, I still need to report it?
Correct. It's about the aggregate balance, not the average or the amount held for the majority of the year.
Let's move on to the consequences. Sam, what happens if someone overlooks or intentionally fails to disclose these assets?
The penalties can be significant. As the reference article mentioned, the accuracy-related penalty for undisclosed foreign financial assets can be as high as 40% of the underpayment. That's double the standard 20% for other accuracy-related penalties.
Wow, 40%. That's a huge chunk. So if I understand correctly, if someone owes $10,000 in taxes related to income from that unreported account, the penalty could be an additional $4,000.
Precisely. And these penalties are separate from any other penalties for failure to file or pay on time. It can quickly add up.
This reminds me of what we discussed about the compounding effect of penalties in our procrastinator scenario. Even small oversights can snowball into substantial financial burdens.
This is really helpful. I'm starting to understand how crucial accurate reporting is, even if you're not intentionally trying to hide anything.
So to recap, U.S. citizens and residents with foreign financial assets above certain thresholds have specific reporting obligations. Failing to meet these obligations can trigger substantial penalties, reaching up to 40% of the underpayment. This is particularly true for undisclosed foreign financial assets. Remember, ignorance of the law is not a defense.
Definitely food for thought.
It absolutely is. Our call to action today is clear. If you have any foreign financial assets, even if you think they might be exempt, take the time to research the specific reporting requirements. If you're unsure, consult with a qualified tax professional. Don't let an overlooked account turn into a financial nightmare. Now, let's switch gears and talk about another type of penalty that carries even more severe consequences: penalties related to fraud and frivolous filings. Let's talk about a scenario: the inflated expense report. Imagine a business owner, let's call them Bob, who runs a small bakery. Bob decides to inflate his business expenses on his tax return, claiming he spent much more on ingredients and supplies than he actually did. He figures this will reduce his taxable income and therefore his tax bill. This, unfortunately, is a classic example of tax fraud. So, Sam, to kick things off, what constitutes tax fraud and what are the potential repercussions?
Tax fraud essentially boils down to intentionally misleading the IRS about your financial situation to avoid paying your fair share of taxes. In Bob's case, deliberately inflating expenses falls under this umbrella. The repercussions can range from significant financial penalties, often much higher than the initial tax avoided, to criminal charges, including fines and even jail time. The IRS takes this very seriously.
So if I understand correctly, even if Bob thinks he's just being clever by exaggerating his expenses, he could actually be facing serious legal consequences. This isn't just a slap on the wrist, right?
Exactly. The IRS distinguishes between honest mistakes and deliberate attempts to deceive. There's a big difference between accidentally miscalculating a deduction and knowingly fabricating expenses. Intent is key here.
That's a critical point, Sam. The IRS looks at the taxpayer's intent. And Taylor, to your point, the penalties for fraud are much steeper than those for simply filing late or making a calculation error, as we discussed in our previous segments. Our reference article highlights that the penalty for tax fraud can be up to 75% of the underpayment due to the fraud.
Wow, 75%. That's a huge chunk. This reminds me of what we discussed about the penalties for failing to file, which, while serious, are nowhere near as severe.
Precisely. And let's not forget the potential for criminal prosecution in cases of blatant fraud. Sam, could you elaborate on the ethical considerations that should guide business owners like Bob in their tax reporting practices?
Absolutely, Alex. Ethical tax reporting starts with honesty and transparency. Business owners have a responsibility to accurately represent their financial dealings. It's not just about following the rules, it's about upholding integrity and contributing fairly to the system that supports our society. Think of it this way: roads, schools, public services, these are funded by our collective tax contributions. When individuals or businesses cheat the system, it affects everyone.
So it's not just about Bob and his bakery, it's about the bigger picture of contributing to the community.
Exactly. It's about the social contract we all have. Now let's quickly recap what we've covered. Tax fraud is intentionally misleading the IRS, and the consequences can be severe, ranging from hefty fines to criminal charges. Ethical tax reporting hinges on honesty and transparency, representing a broader commitment to the community. Remember, understand the legal and ethical boundaries of tax reporting, and always prioritize honesty and accuracy in your financial dealings. It's not worth the risk. Now, while Bob's situation highlights intentional fraud, there are other ways people run into trouble with the IRS, sometimes through genuinely misguided beliefs about taxation. In our next segment, we'll explore the case of a tax protester who files a return filled with frivolous arguments, leading to further complications. Now, let's shift gears slightly to another form of fraudulent filing, the tax protester. This scenario involves an individual who files a return with frivolous arguments and even alters documentation. This, unfortunately, results in a hefty penalty and potential legal trouble. Taylor, imagine someone believes they don't have to pay income tax because they consider it unconstitutional. They file a return riddled with these kinds of arguments, maybe even crossing out pre-printed sections or altering the forms. That's our tax protester scenario. Sam, what are considered frivolous tax arguments, and why are they penalized so heavily?
Frivolous tax arguments are those that lack any legitimate basis in tax law. They are often based on misinterpretations of the law, conspiracy theories, or outright denial of the tax code's validity. The IRS penalizes these filings because they waste resources, clog the system, and ultimately undermine the integrity of the tax system. The penalty, as mentioned in the publication 17, can be as high as $5,000.
$5,000. That's a lot. So claiming you're exempt from taxes because you work for a private company or because you only deal in cash would be examples of frivolous arguments, right?
Exactly, those are classic examples. The IRS has encountered many variations of these arguments, and they maintain a list of positions they consider frivolous.
So if someone genuinely has a concern about their tax liability, what options do they have besides resorting to these frivolous filings? What resources are available to them, Sam?
The IRS actually offers several avenues for taxpayers to address their concerns legitimately. They can file an amended return if they discover an error. They can also request an offer in compromise OIC if they're facing significant financial hardship and can't pay their full tax liability. And of course, they have the right to appeal an IRS decision through the appeals process.
So, if I understand correctly, if I disagree with how the IRS calculated my taxes, I can appeal, but I need to base my appeal on actual tax law, not just a belief that the tax code is unfair. This reminds me of what we discussed about negligence in the DIY deduction disaster scenario. It's important to understand the rules, even if we don't agree with them.
Precisely. You need to present a valid legal argument. You can't just say, I don't think this tax applies to me. You have to show how the law, as written and interpreted by the courts, supports your position.
A key point here, Taylor, is that while the system may seem complex, legitimate channels for addressing concerns do exist. Resorting to frivolous arguments not only invites penalties, but can also lead to more serious legal issues. So, to recap, frivolous tax arguments are those without a valid legal basis and are subject to significant penalties. Resources like amended returns, offers in compromise, and the appeals process are available for taxpayers with genuine concerns. Taylor, any final thoughts?
It's really important to emphasize that while it's okay to question or disagree with aspects of the tax system, it's crucial to express those concerns through the correct channels. Filing a frivolous return is not the answer.
Exactly. Address your tax concerns through legitimate channels and avoid frivolous filings that can lead to significant penalties and even legal repercussions. And that concludes our deep dive into the world of IRS penalties here on Safe, Simple, Sound Tax Edition. We covered a lot of ground today, drawing from that IRS Publication 17 to understand the potential consequences of not meeting our tax obligations. We explored the difference between penalties for late filing and payment versus those for accuracy-related issues, and even touched on the serious repercussions of fraud and frivolous filings. Remember those key takeaways. Seemingly small oversights can lead to significant financial burdens, and proactive communication with the IRS is key. I think the scenarios of the procrastinator and the DIY deduction disaster really highlighted how easily we can fall into these traps and hopefully provided some actionable strategies to avoid them. Remember, understanding these penalties empowers us to seize financial control and make informed financial choices. Thank you for joining me today on Safe, Simple, Sound Tax Edition. Check out the show notes for all mentioned resources, including IRS sources and helpful tools. If you found value in this episode, please leave a review and share it with someone looking to better understand their financial choices. This is Alex, wishing you safe, simple, and sound financial journeys.